Okay, now we're looking at problem 8, 6b. We'll do 8, 6, 7, and 8b. In problem 6b, we look at the disposal of plant assets. And when you dispose of an asset, you have to calculate the book value so you can determine if you have a gain or loss, because you have to report that on your taxes as well as on your financial statements. So in the first one, it asks us to prepare journal entries to record the machine's purchase and the cost to ready and install it. Cash is paid for all costs incurred. So on January 1st, we purchased the machinery, so we put that on the books, long-term asset, of $150,000. That was for cash, $150,000. Okay, then on January 2nd, we got the machinery ready to use, and so that goes into the cost of the machinery, which is depreciated rather than expensed, $3,510. And then on January 4th, that same piece of machinery, so we all have the same machinery here, we have $4,600 to mount that so that we could use that in our operations. Okay, then it asks us to prepare journal entries to record depreciation on the machine at December 31st in its first year of operations and in the year of its disposal. And so in 2A, first year, we, on December 31st, we have depreciation expense and the accumulated depreciation, which shows up on our financial statements under the assets so that the readers of the financial statements can calculate the book value. So the depreciation expense, I'll just go ahead and calculate it here, is $158. That's the cost of the machine. All of the cost, all three of those costs are included in the cost, minus $18,110, which is the salvage value, which was given to you in the problem, and divided by 7. That's the number of years. So we'll take depreciation of $20,000 each year for the machine. And this was purchased on January 1, so we take a full year. Then in the year of disposal, the 6th year, well, is that what it's, yeah, year of disposal, 6th year, 6th year, it's the same entry. So every year for 7 years, we make the same entry, $20,000, because it's straight line. The only time straight line would change is if one of our estimates changed. So if their number of years or if the salvage value changed, then it would change our straight line depreciation, but otherwise that never changes. So then in 3A, they ask us to prepare journal entries to record the machine's disposal under each of the following separate assumptions. So in A, it was sold for $28,000 cash. So we received cash of $28,000. That's a debit. And then the other thing we have to do is take the accumulated depreciation off the books and take the machinery off the books. Because we've sold it, we no longer have that machinery, and we have to take the associated accumulated depreciation off the books. And so the machinery was $158,110. That was the cost. The depreciation at the end of its life would be $120,000. Is that right? First 6 years of depreciation. And so in this scenario, the book value would be, I'll go over here and calculate it. The book value is the $158,110 minus depreciation, $120,000, or $38,110. So if the book value is $38,110 and you sold it for $28,000, you had a loss. So you have loss on the sale of the machinery. And that loss would be $10,110. The other way is, you know, your debits and credits have to equal, and if it's a debit, it's a loss. If it's a credit, it's a gain. That goes back to your, when we learned about journal entries and account balances. Okay, the next scenario, 3B, asks us to do the same calculation, except this time it is sold for $52,000 cash. So cash is $52,000. And you have the same entries. You take the accumulated depreciation off the books, you take the machinery off the books for the same amounts, and then you just have to determine if it was a gain or a loss. And so, again, you can come over here and you can say my book value is $158,110 minus my accumulated depreciation. And so my book value is $38,100. I sold it for $52,000, so I must have sold it at a gain. So I have gain on sale of machinery, and you can do that, calculate that however you want, but that's one way you could do it. $13,890 is the gain on the sale of machinery in that scenario. In scenario C, it says it's destroyed in a fire and the insurance company pays $25,000 cash to settle the loss. So again, you have cash, $25,000. We don't have the machine anymore, so we have the accumulated depreciation coming off of the books, $120,000. The machinery comes off the books, take that off the books, so we decrease that, $158,110. And the difference then is called a loss on fire, if there is a difference. And in this case there is, and that's $13,110. So that takes care of problem 8.6b, and next we'll look at 8.7b, and I'll look at that on the next video.